Imagine you went to an ATM and it displayed a message. Sorry, you can only have a small fraction of your money right now. You'd be furious, right? Well, that is essentially what is happening right now to investors with billions of dollars sitting inside funds run by some of the biggest names in finance. BlackRock, Blackstone, Blue Owl. They offered strong returns and they sold the idea of liquidity. But now that fear is moving through the market, they are suddenly changing the rules and slowing access to that money. The arrangement was simple. Give us your money. We will invest it in things you cannot normally access, like loans to mid-sized companies, and you will receive higher returns. And as a bonus, if you needed your cash, you could pull some of it out on a regular schedule. For years, that model worked. It helped drive the private credit market to a size of more than $2 trillion. But now that growth story is starting to crack for anyone who wants out. We are going to examine exactly how these financial giants are restricting investor withdrawals, why they are being forced to do it now, and what it says about the deeper fragility underneath our financial system. The headlines started as a murmur. Now they sound like a roar. In early March 2026, BlackRock, the world's largest asset manager, sent a shockwave through the market. They announced they were capping withdrawals from their $26 billion private credit fund, the HPS Corporate Lending Fund, also known as HLEND. Investors rushed for the exits, asking to withdraw 9.3% of the fund's total shares. But BlackRock said no. They hit the gate, limiting redemptions to just 5%, the maximum allowed under the fund's own rules. In simple terms, investors asked for about $1.2 billion back. BlackRock released only around $620 million. The rest stayed frozen. And this was not a lone occurrence. The move came only weeks after another major player, Blue Owl Capital, faced its own liquidity stress, limiting withdrawals and selling assets to manage the pressure. The fear spread fast. News of BlackRock's decision pushed its stock lower, and shares of other major players like Blackstone, KKR, and Carlyle dropped right alongside it. Even Blackstone, which wanted to project stability, showed clear signs of strain. Their flagship private credit fund, BCRED, saw a record surge in withdrawal requests. To avoid the optics of shutting the gates, like BlackRock, Blackstone used unusual methods. While their rules allowed them to limit withdrawals to 5%, they raised the cap to 7% and then had the firm and its own employees inject $400 million of their own money just to handle the rest, and say they met 100% of the requests. Think about that. A giant like Blackstone had to use money from its own reserves to stop a full-blown run on its fund. That is the heart of the issue. The largest names in finance offered investors an exit, but when too many tried to leave at once, the doors got very narrow very fast. The system is straining under the pressure, and it is exposing a harsh reality about where the real risk sits. So what exactly is going on here? To understand why this is happening, you need to see the mechanism that is failing. We are talking about the world of private credit. For years after the 2008 financial crisis, banks faced much tighter rules, and that made it harder for them to issue certain kinds of loans. But the need for those loans did not disappear. A new class of lenders stepped in to fill the gap. Private credit funds run by giants like Blackstone, Apollo, and BlackRock. They went to large institutions and more to wealthy individuals with a very appealing pitch. Banks are boring. Give your money to us. We will lend directly to companies doing buyouts and acquisitions. Because these loans do not trade on public markets, they look less volatile, and we can give you a higher yield. For a while, that was a very good deal. The private credit market surged, growing to nearly $3 trillion. But here is the fatal flaw. The ticking time bomb at the center of this market is a massive liquidity mismatch. These funds invested in long-term illiquid loans. These are not shares you can dump in a second. They are complex private loans that are hard to value and even harder to sell quickly. Yet to pull in a flood of retail money, these funds were structured as semi-liquid, promising investors they could get money out quarterly. This is the financial version of borrowing short and lending long, a classic setup for a bank run. You promise investors access to cash on a short timetable while locking that same cash into long-term assets you cannot easily sell. For years, as long as markets stayed calm and returns stayed high, nobody cared. But now fear is building, and the spark behind the current panic seems to be a concentrated bet on one specific sector: software companies. Some reports suggest many of these private credit portfolios carry a significant share of loans tied to software, in some cases as high as 19 to 30%. With the rapid rise of AI, investors are suddenly worried that many of these older software firms could become obsolete. That fear is now feeding concern over defaults. And that fear, even before proven defaults, was enough to start the rush for the exits. This is a textbook confidence problem. You do not need the loans to actually blow up right away. You only need enough investors to believe other investors are about to run for the door. Once that belief takes hold, it becomes self-fulfilling. The first person yells fire in a crowded theater, and the stampede begins. Funds are then forced to sell assets to meet redemptions, but because the loans are illiquid, they may have to sell their best assets first and sell them at fire sale prices. That drags down the fund's value, which creates even more fear, which leads to even more redemptions. That is the doom loop. The liquidity they offered was real only while almost nobody asked for it at scale. These are exactly the kinds of complex stories we break down here. The financial world is full of jargon designed to keep ordinary people on the outside looking in. So why should this matter to you if you are not one of these wealthy investors? Because the fallout is bigger than a few people not getting their money back on schedule. This is a stress test of a massive, opaque, and only lightly regulated corner of the financial world, and the early results are not reassuring. First, this exposes the lie of semi-liquid. For years, asset managers pushed these products hard to retail investors, a group they call the private wealth channel. They sold the idea that you could get the high returns of private markets with the supposed safety of periodic withdrawals. What we are seeing now shows that was a dangerous illusion. These are fundamentally illiquid investments, and retail investors are learning that lesson the hard way. A Morningstar analyst put it well, saying this should serve as a warning sign for the industry and for rule makers about the downside of illiquid funds sold to retail investors. That promise was a marketing device. Now the bill is coming due. Second, this creates a serious contagion risk. Private credit does not exist in a vacuum. These funds are tied deeply into the traditional banking system. Banks provide the massive credit lines these private funds use to operate. Moody's has warned that as these funds get squeezed, they may draw heavily on those lines, putting pressure on the same banks people still think of as too big to fail. The recent failure of a smaller UK property lender tied to Blue Owl rippled through creditor banks and added to wider industry volatility. These are not isolated incidents. They may be early signs of something much bigger. Finally, this is the first major test of a market that has known almost nothing but growth. This industry was built in an era of zero interest rates and endless optimism. It was driven by loose lending standards and risky practices like covenant-light loans, which give lenders fewer protections, and PIK, or payment-in-kind interest, where borrowers pay debt with more debt instead of cash. Now, with higher interest rates and a huge wall of refinancing ahead, the system is starting to fracture under the strain. Easy money is gone. The tide is going out. And now we are seeing who was swimming naked. The real question is whether this remains a problem for a few over-leveraged funds or whether it turns into a systemic break inside the broader private credit world. In the end, this is not just a story about a few Wall Street giants. It is a cautionary story about promises, risk, and the relentless chase for return. These firms created a product that looked safe in sunshine but was built to fail in a storm. And now the storm is here. The immediate fallout is that thousands of investors are finding out their money is not nearly as accessible as they were led to believe. The larger and more unsettling question is what comes next. Will these gates and withdrawal freezes contain the panic? Or are they just the first pieces falling in a much larger systemic crisis? This is more than a liquidity issue. It is a confidence issue. And in finance, confidence does a lot of the work until the moment it breaks. What do you think? Is this an early sign of a much larger crash still ahead? Let me know in the comments below. History rhymes. Power rebrands. Stay inquisitive.